And welcome back to yet another exciting week of the Lazy Money Game. I will start this week's episode by illustrating a very interesting point about how we as human beings are best at thinking in linear terms, meaning that it is hard for us to understand the power of compounding. I will illustrate this through an example. Afterwards, I will give an update to my portfolio as well. So what do I mean by we as human beings are best at thinking in linear terms? Well, let me try to explain you this through an example, since one of my viewers informed me that they know someone who have bought a house for 2.5 million and they were capable of selling that for 7.3 million 17 years later, meaning that they had a gain of 4.8 million. This is in Danish kroner, and I mean, at first glance, this sounds like a truly astonishing return, but what you need to consider here is it is over a period of 17 years. So what at first glance here sounds like a truly amazing investment which must have given you truly astonishing rate of returns. Well, I'm a number guy, so I plug these numbers into my Excel spreadsheet, and then I will scroll down here and you can see over a period of 17 years, this is actually equating an annual interest of 6.5%. So this is something that you would actually expect to receive in the stock market, and in the stock market on average over the last 90 years, at least if we're looking at the S&P, you would be able to significantly beat these numbers. So this is just to once again prove the point of why it is so important for me to invest as much as I can, as fast as I can, into the market of stocks. And it is not a coincidence that I call it a market of stocks and not a stocks market, because what you're seeing currently is that the market as a whole is really richly valued, meaning that there shouldn't be so many good deals out there for you. But I truly believe that you will always be capable of finding stocks that suit your needs. And in my case, that means stocks which pay out a dividend, which I'm showing you in my portfolio. So if we now take a closer look at my portfolio and see what has happened within this week. So the first thing we immediately notice is that there's a green circle for this week's episode, meaning that the portfolio is up in value compared to last week. If we then go to the portfolio value tab, then you can see that the value of the portfolio has increased with a little more than $8,000, but at the same time you can see that the cost has also increased close to $8,000, meaning that I'm up around $650 within this week. And for those of you who are interested in the precise number, then you can take the value of the portfolio this week minus the value of the portfolio last week, and you take the cost for this week minus the cost for last week, and then you subtract the cost from the value of the portfolio. Hence you can see that the portfolio is up $641 within this week. And while we're on the topic of the value and the cost of the portfolio, I mean, look at week 44 last year and the value of the portfolio today. The value of the portfolio now is more than double the amount that what it was back in week 44. So if we take the value of today minus the value that we had back in week 44, then it has increased by $68,000. This is of course not just due to increase in the stock price. I have also added a lot of additional capital, but I mean, if we then subtract the extra capital which I have added, which is $32,000, that means that I have actually still had a gain of $35,000 within a time span of 26 weeks. And that return, I mean $35,000 divided by the value of the portfolio, gives me a return of a little more than 26% over a 26-week period. You should not expect to receive returns like this. This is just to show you how volatile the stock market is. And I mean, 6.5% in annual income, which people really think was an amazing return. Look at what can happen in the stock market. I'm not saying this is going to happen. I'm just showing you this is what has actually happened in this portfolio. So what point do I actually want to prove here? Well, The important message for me is the only reason that I have been capable of seeing a return of more than 26% over the last 26 weeks is due to the fact that I didn't panic last year and sold all my stocks. I was holding and I kept adding more money into the portfolio. Hence, when the stock market starts to recover, then you take part of that gain. And this is why it is so crucial only to invest in something which you truly understand or that you actually believe in, so you don't panic and sell when everyone else are selling. If we then continue to my favorites tab, namely the dividends tab, then you can see that I have received quite a large dividend within this week, since I have received a little more than $165 from Store Capital, bringing me very close to $200 in total for this month. And this makes me truly happy, since if you go 3 months back, you could see that I in total received $139 for that month. And if you go additional 3 months back, you could see that I got $66. So I am truly adding more money into the portfolio. Hence, my dividends keep on increasing. And with my latest purchase, I have actually surpassed my goal for this year of receiving an estimated yearly income of above $3,600. And why $3,600 in particular? Well, that was because then I will receive $300 on average every single month, and that was my highest paying month last year. So with that in mind, let's go back to the overview arc and have a closer look at the stock which I have actually added within this week. So if we take a look at the portfolio pie chart here, then it is no secret that it is in the healthcare sector that I have added an additional company, since you can see that the healthcare sector now makes up more than 34% of the entire portfolio. So if I scroll up here and then zoom in a bit so it becomes even more clear, then you can see in the middle here that I have added 100 shares of Merck. And as you can see here, I paid $7,759 for the 100 shares. If we then scroll to the right, you can see that that gives me an additional $260 in annual income from the dividends before the withholding tax, giving it a dividend yield of 3.35%. And instead of going through my normal guidelines on why I think this company fits into my portfolio, then let me try something different this time. Because if we go and take a look at the annual shareholder meeting from Berkshire Hathaway back in 1999, I won't show the clip due to copyright issues, but if you go to the morning session and go 1 hour and 37 minutes and 16 seconds in to this clip where it say we blew it on pharmaceutical stocks, here they talk about how pharmaceutical stocks have been some of the best companies for their consumers, since they have greatly improved their life. But one of the reasons why they blew it back in 1999 was they thought that the pharmaceutical stocks was too overvalued. So let's take a look at Merck and their stock price. And I mean, you can actually go back and see their stock price for April back in 1999. There you could buy it for around $70. And I mean, today you can buy it for a little less than $78, meaning only an $8 increase over a period of 22 years, suggesting that this stock probably is not overvalued today. Hence, this is also a conviction for me why I want to be in this business, since I truly believe that Warren Buffett and Charlie Munger knows what they are doing, and they have learned from a mistake they made 22 years ago. If you want to know more about Merck, then I highly suggest that you go and check out the company webpage. You can see the link in the description below. If you then go to the About section, you can see that they aspire to be the premier research-intensive biopharmaceutical company in the world. You could also go and take a closer look at the pipeline and see that they currently have 22 drugs in the phase 3 program. The reason why I focus mostly on phase 3 and not so much on phase 2 is due to the fact that there is so much uncertainty with whether or not these will actually hit the market, and the earlier the phase, the higher the uncertainty is. But this is just to show that there is actually a strong pipeline here, meaning that they have a lot of potential products hitting the market in the future. If we then take a look at what the insiders are doing and look for purchases, well, then we get truly disappointed because there is actually not a single purchase being done by any of the insiders in Merck. What we are seeing here is a lot of sales, and one thing that I want to note here is I don't put too much attention if I see managers selling, because they can have all sorts of reasons for why they want to sell some shares in the company. The reason why I put a lot of emphasis on purchases is they are never forced to purchase any stocks. So if they want to up their stake in a company where they have a lot of information, then that is a strong indication for me that they at least believe in what they are doing. So in this case, I can't get too much information out of the insiders, unfortunately. If we then go to macro trends and have a look at the financials, if we start with the revenue, we can see that the revenue has been increasing since 2015. However, if we actually go back some years, you can see that back in 2011, the revenue was actually higher than what it was here in 2020. So this is actually not as good as you could perhaps make it if you only looked at the last 5 years. And if we take a look at the operating expenses, you can see here that they actually spent a lot to do their business last year. You can see operating expenses actually increased quite a bit. This is not too surprising, but it's not really a good thing to see that the operating expenses has been increasing like this last year. If we then look at shares outstanding, I'm happy to see that the company is lowering the amount of shares outstanding, meaning that they're buying back their own shares. This is what you want to see as a shareholder. If we then continue to the balance sheet, just to see if the company has a strong balance sheet, then I always look for total assets being higher than total liabilities, and this is definitely the case. You want to have a ratio above 1, and here you have a ratio a little lower than 1.5. So a strong balance sheet, which is a positive as well. If we then turn to news related to the companies in the portfolio, then there are some big news, since Store Capital have named a new CEO, namely Mary Fedewa, and she has taken over from Mr. Volk, and this was actually effective as of April 15th. So this is seriously big news. I mean, Christopher Volk is everything which I could wish for in a CEO. So these are some seriously big shoes to follow in. But luckily, Mary Fedewa was one of the founding partners of Store Capital, and she has immense experience here. And if you just took a look at what Store Capital stock did when this news was announced, the stock actually went up 3% in the day. So at least the general market thinks this is a good transition. And if you want to know more about Mary Fedewa and her qualifications, I highly suggest that you go to Store Capital's webpage and check out the full description of her. I have of course included a link in my description below, so you can go and check it out for herself. It is truly amazing, and she has been serving as Store Capital's COO for 3 years. So she truly has a lot of experience in this field. So I'm very much looking forward to hear her first quarterly presentation for Store Capital. So that actually sums it up for yet another exciting week of the Lazy Money Game. So now you have at least seen once again an example on something that looks to be an astonishing return, but once you actually go and take a closer look at the numbers, it was actually quite a modest return, and definitely not something which is unachievable if you are investing in stocks. So this, to me at least, confirms why I should keep on investing into my portfolio, because I truly believe that 6.5% or more than that is a possibility to get, especially when you take the last 90 years of data into consideration, where you have been able to get around 9.5% from the S&P 500. So if you like content like this, then please consider leaving a like or subscribing to the channel or leaving a comment. It really helps out a lot. And until I see you next Sunday, bye!